Hey everybody, how's it going? Hope you're all doing well. Welcome back to another episode of Blockchain and Beyond. As always, I'm your host Farzan. On today's episode, we're going to be talking about tax. So, in both the UK and the US, the tax season just ended this April, and probably as well in a lot of other countries. But when it comes to tax, it usually comes down to a self-assessment. So you have to do your own reporting on any capital gains or income tax you've received as a result of cryptocurrency. And I am by no means a tax expert, so please do your research before you actually do anything. Or, you can speak to a tax expert. I'm sure you can find some in your local area online. And there's also a lot of free resources online to help you understand how these taxes are calculated. And that's what we're going to go into today. We're going to be talking about the different types of tax, in particular in the UK regarding crypto, because the government actually splits crypto up into capital gains tax, income tax, and also property tax in certain situations. And each of these have their own little nuances, so I'll try to, explore some of them to hopefully help you understand how the tax system actually works in the UK. So we're going to start off with the crypto capital gains tax in the UK, because it's probably the most important one and it's probably the biggest one that will impact most of us. So HMRC, which is the UK's central body when it comes to taxes and that sort of stuff, see crypto as a capital asset. So what this means is when you buy and then sell this crypto, it will be counted as capital gains tax. And they call it a disposal. And these disposals can include selling crypto for either pounds or another fiat currency, trading crypto for other crypto, including stablecoins. So, doing any swaps on your crypto is applicable for capital gains tax. Spending crypto on goods and services is also one of the ones that they've added under this list of capital gains, which is kind of weird. So if you buy some crypto and then use that crypto to buy something else, you're liable to actually pay capital gains on this. And you also have to pay capital gains tax on any gifts, unless it's to your spouse or civil partner. But on the plus side, this capital gains tax is only on the actual gains that you have. So only if you've actually made a profit when you actually dispose of this crypto. The UK also has a capital gains tax allowance of £12,300. So that means any profit you make up to £12,300 is basically tax-free. You don't have to pay any tax on that. But anything over that which you earn, it will be applicable for tax. And then the tax is actually broken down into bands. So it's not a case of long-term or short-term capital gains. Rather, it's in terms of bands based on how much you earn. So up to from 12,300 to around 50,000, it's a 10% tax rate. From 50,000 to 150,000, it's a 20% tax rate. And actually, even above 150,000, it remains at 20%. So just a quick example, if you earned, say, £20,000 of capital gains tax this year, 12,300 of that is tax-free. So you'll only have to pay capital gains tax on about £7,700, which would fall into the 10% tax rate. So on this £7,700, you would pay a 10% tax, which is £770. But the UK actually go a step further and make this a bit more complicated. This is to do with your cost basis, which is how much you actually paid for your crypto before you then go and sell it. So your cost basis is the cost of the crypto that you bought plus any fees, such as brokerage fees or transaction fees. So a quick example, if you spent £100 to buy some crypto and you paid, say, a £5 transaction fee, that means your cost basis for the crypto that you bought would be £105. So it gets more complicated because the UK has 3 different rules for share pooling, and it has 3 specific cost basis rules. So the first one is the same day rule. And the same day rule basically says if you buy and sell coins on the same day, you need to use the cost basis on this day to calculate your gains or losses. And if you're selling more than you bought on that day, you need to move on to the next rule. So if on a particular day I bought 1 Ethereum, but later that day I sold 2 Ethereum using some form of my holdings, the first Ethereum I sold would fall into the same day rule. So I would use the cost basis of that first Ethereum that I bought, whereas for the second Ethereum would actually be applied to the next set of rules. So the next rule is called the bed and breakfast rule or the 30-day rule. And it says if you sell and repurchase the same coins or tokens within 30 days, you'll use the cost basis of those tokens you bought within this month to calculate your capital gains or losses. So what this means is that you'll need to keep track of not only the coins that you bought on that particular day, but also your cost basis of the coins you bought over the past 30 days. And then there's also a third rule that they have. So this is the section 104 rule. And it basically says that if your crypto transactions occur after 30 days, so if you bought it, say 2 months ago, and then sold it, you basically just average out everything you bought beyond the 30-day point. So this includes all crypto you may have bought years ago, or cryptos that you may have bought 2 or 3 or even 6 months ago. And that's when a lot of these tax calculations start to get really complicated. And there are a few softwares online which can actually help you with this. So one of the ones that I've seen is Coinly, and the other one that I've used is the crypto.com tax service. So both of these are free to register and sign up for. I think Coinly has some costs attached, whereas the crypto.com one is free. And there's plenty of other applications available as well. And how these tools basically work is either you import your transactions, or you can connect your accounts to the application. So whether it's your Coinbase account or your Binance account, they have a lot of integration for many exchanges and different wallets as well. And when you import these, they will basically pull all of your transaction histories and calculate everything for you in terms of your cost basis, your capital gains or losses, and how much you may need to pay overall. And it also includes everything you'd need for the same day rule, the 30-day rule, and the average cost rule. So it basically does it all for you to make it a lot more simple. And then what they can do for you is also export your tax report for you, which then you can submit to HMRC. And one thing I actually forgot to mention about the crypto capital gains tax is you can actually offset any of your losses. So if you say made £20,000 in profit, but you made say £5,000 in losses, you can basically offset your £20,000, meaning you are only applicable to pay capital gains tax on the £15,000 that you've actually earned. So this can be one of the ways that you optimize how much tax you actually end up paying. And I think there's even services which can help you calculate this, or even help optimize this to help minimize the amount of tax that you need to pay. But I've not used any of these services myself, so I can't really speak on how they work or what the functionality is. So that basically covers capital gains tax. The next type of tax which they actually outline is income tax. So most of us will already be familiar with income tax. For most people who are working, will be paying income tax through our employer. And so with income tax, it's £12,500 is about tax free. Then anything from there up to around 50,000 is a 20% tax rate. And then I think there's a 40% and a 45% tax band. So how this actually fits into crypto. So the UK's government has put things like staking as income tax. So whether you're staking Ethereum or Polkadot or Algorand or Cardano, any of these cryptos which you can stake and you're getting income from them. This includes staking pools on like different DeFi protocols. So whether that's on Uniswap or PancakeSwap or one of these other platforms, that will all count towards your income tax. For other methods that actually count as income tax include getting paid in crypto. So if your employer actually pays you in crypto, you're actually eligible to pay income tax on that, as well as national insurance. We already mentioned staking rewards, but also mining. So if you're mining Bitcoin at home, that actually counts as income. And there's also rules regarding airdrops and also forks. Soft forks can happen on any chain or most chains at any time, and these aren't taxable. What is taxable is hard forks. So hard forks is when, on a technical level, when there's a difference in which protocol should be run by the validators of this blockchain. So you end up with crypto on 2 different blockchains. And what the HMRC says is that you don't actually pay tax on the new coins as a result, but you will still have to pay capital gains tax when it comes to actually selling these tokens, and the cost basis will be based on the initial cost basis of the original tokens which you had bought. And now we come to airdrops. So HMRC considers airdrops as income when you've done something to actually earn it. And they say that this could be simple actions such as sharing a social media post or being rewarded because of previous trades that you've done on, a platform or a blockchain. So in most instances, airdrops will be considered as income and you'll have to pay income tax on those. However, airdrops aren't considered income if you receive them without providing some sort of service or action in return. So an example of this, there was recently the Ape coin which was launched and airdropped to holders of the Bored Ape Yacht Club. this would be considered as income, as people would have had to initially buy the Bored Ape Yacht Club NFT before actually receiving this token. There's also a downside to airdrops. So not only do you pay income tax when you receive these tokens, but you're due to pay capital gains tax when you actually sell these tokens. So if when the airdrop happens, the token is valued at £1, you have to pay income tax on all of the tokens that you received at £1 each. And then when you actually sell them, say you sold them for £2, you would have made a profit of £1 per token, and you would have to pay capital gains on that. So airdrops are actually double taxed, which is quite unfortunate, but that's how it goes. Now, when it comes to gifting crypto or doing donations in crypto, so if I'm giving a gift of crypto to a friend, that's eligible for capital gains tax. However, if I'm gifting crypto to my spouse or my legal partner, that is not a taxable event. So I can actually use this to take advantage of this legal tax loophole, which lets you take advantage of both people's capital gains tax allowance in the household. Donating crypto to charities is also a tax-free event in the UK, but there is an exception in the case that the person makes what's called a tainted donation. So this refers to a situation where an individual makes an arrangement with the charity to get some sort of kickback or financial advantage from their crypto donation. And that covers most of the tax things I wanted to discuss. So just a quick recap. So tax is one of the more complicated events, especially when you have to do self-assessments. But the key things we looked at is capital gains tax. So when you buy and then sell crypto, you have to pay any capital gains tax on these. There's a few complicated rules, but there's software out there to help you with that. And the key thing being that these programs, or you yourself, can also use any losses from your trades to actually offset how much tax you're paying. And the other thing that we looked at was taxable income from crypto. So this includes staking or rewards from staking your crypto somewhere. But this also includes things like airdrops. And the thing with airdrops being is you're taxed as income tax when you receive them, but you're also taxed on capital gains when you actually sell them in the end. So I hope everyone enjoyed this. I've been meaning to do this episode for a while. I just hadn't gotten around to it, but I'm glad that I have now, because I think tax is one of the things which probably scares or confuses people quite a lot. But once you eventually get your head around it, it's not too complicated. But as always, if you do have any questions, feel free to get in touch. It would be great to hear from you. But until next time, goodbye.